Hello, this is Charles, Dr. Charles Conrick. This is trading spreadsheet trading part 6 for the vertical option spreads 1.8 standard deviation inflection point. Again, I want to thank you for being with me. Today we're going to be more specific than I have been in the first 5 sessions. In the first 5 sessions, we were effectively looking at um, the spreadsheet, learning how to use it, and working with it. Today we're actually going to work on setting up trades, and specifically we're going to cover the bull put, the bear put, the bull call, and the bear call spread. So we're going to be looking specifically at 4 different spreads. I'm going to be using the Standard & Poor's 500 ETFs SPY, Sierra Papa Yankee, and in conjunction with the trading spreadsheet, I'll be using Options Express website. Options Express is a great options platform. It's just an excellent option platform and a great company. If you wish to trade with Options Express, you really you can't go wrong as far as I'm concerned. Great company. So that being said, we're going to set up in the trade and probability calculator, where you can go into the toolbox, down to trade calculator. That's where I've went to. And today is December the 8th, 2013. The SPY closed on Friday at 181, just under 181. That's close enough for government work, I think, for us. Volatility was bumping around a bit last week. As you might recall, during the first 4 days of the week, the S&P went down about 5 to 6 to 7 points each day, until finally we had a very good jobs report, or at least an adequate jobs report, on Friday, December the 6th, and the S&P went up 20 points in one day, so it recovered most of its losses of the previous 4. So what I'm looking at here is, okay, next week, which would be week ending December the 13th, Friday, options that would expire on week ending December 13th. And the first one we're going to do is a bull put trade, a bull put. Now, keep in mind, the SPY is trading at let's call 181. It's down here at the bottom. You can see the closing price on Friday. But 181 is close enough for us to remember. Now, with a bull put spread, the bullish portion means that you think the price is going to go up. Bull put spread is a credit spread, which means you're going to get money back for it. You're buying a lower priced put, selling a higher priced put. So depending upon the volatility in the option chains, we'll see what kind of credit we'll get. So for this, what I'm going to do is go into the week 2 options, the expiration week 2, second week of December, and I'm going to put in, I'm going to go in with a 178 put on the short side, or on the long side, and a 179. Now the reason I'm doing this is that I'm being a little bit conservative. In other words, I think the SPY is going to go up, but I'm not sure, so I'm giving myself a little bit of room, trading room, below the 181 price. In other words, it can come down, obviously, 20 points, and I still might be able to keep my credit. So we're not talking about any probabilities yet or anything like that. We're just basically pretending we're a guessing trader, and we're going to see what happens. So we'll put in 1 each to experiment with this, and we'll leave it at market price and just calculate the trade. What the trade calculator does for us is to show us, all right, what is the maximum gain or maximum loss on the trade. You can see it over on the right-hand side of the screen where I'm playing with the cursor. So the maximum gain is 11 cents, so 11% on $100. Maximum loss is $89. Now, at first glance, you might say, well, that stinks. But I don't want to make a trade like that. Well, it depends. It depends on the probability of what the trade will bring us. So don't just dismiss a trade like this, out of hand. Now, obviously, if we move up closer, in fact, let's go down, we can go down to the bottom right. as soon as I can figure out how to get the slide bar moved. There we go. And we could go, say, at a 180 and a 181. In other words, we'll put the top leg right at the current price, calculate the trade, and you're going to see the payoffs will be much better. And in this case, it's 34% gain with against a 66% maximum loss. Now, obviously, well, it's a lot better. I can make $34 on a $100 risk. Actually, you don't have a $100 risk. You have a $66 maximum risk with a $34. So almost a 66 to 33, 2/3 to 1/3. So if you really believe, once more, let's state this unequivocally so that you understand it. Now, I'm sorry to sound so pedantic like a college teacher. Well, I am one. But I'm trying to get some very specific thoughts across to you. I mean, in spite of reading all the books and everything else, trading is a function of, well, to me, it's mainly probability. To you, it might be mainly technique usage or analysis of the deltas. What are the Greeks rather? What is my gamma risk and what is my theta risk and the vega risk and on and on. Many of the books, like I've told you before, Saliba goes into great detail. Russell Rhodes goes into detail. Another great author is Yuan Sinclair, EUAN Sinclair. It has some great books on volatility trading. You can pick up a lot of stuff from those books. All right, so that being said, you're going to have to look at, well, how confident am I that SPY is indeed going to go up? I mean, if you're that confident, you might as well just go long call. But the purpose for spread trading, don't forget, is to manage your risk, not just pocket pure profit, but to do this on a consistent basis. Consistent basis. Consistent basis. Week after week, month after month, year after year. That's the way to build your income and to build your net worth. So what we can do is set that same trade up in the trading spreadsheet. So let me go ahead and open that. You now should be familiar with this. And I'm going to set up the trade. I'm on tab option 1. The annual return, I don't know what it's going to be. But since you think it's going to go up, we think it's going to go up. For purposes of this trade, I'm going to pretend I believe it's going to go up at a 10% annual rate. I'm going to key in on the volatility at 9%. The VIX is running at about 13.5 right now. And generally speaking, and we're going to be going into this in more detail in later lessons, generally speaking, the actual volatility appears, evidence has been showing and compiled by me, is showing the VIX is anywhere from 70 to 80%. The actual volatility is 70 to 80% of the VIX. That's a best estimate using regression analysis. Doesn't mean that's what's going to be. Could spike up to 20% for all I know. We're using, again, best estimates. But the purpose of this video is to show the trade. So I've put in the price of SPY at 181. And the strike we're going to go with, we said, would be 180. So set your strike. Now, we'll play with a bull put first. Let me show you how that works. Go to tab option 2, set tab option 2 to 181. That's your short put. Now, I want to look up the prices on Options Express. So let's go down here and see what those prices were, and you'll notice where I'm playing with the yellow cursor. We're at 62 and 96 cents respectively on the trades. So going back to the option spreadsheet, what I want to do is set this cell right here to 96 cents by adjusting the volatility. So we're going to lower the volatility till that cell, whoops, I went right on past it. I was talking so much. All right, there's the short put at 96 cents in the first cell. And on the long put, what we want to do is go in at 67 cents. So I got to bring the volatility way on down, which we'll do very quickly. And we're going to get that all the way down to 67 cents to set up the trade properly. Okay, so we're coming in close. In fact, there we go, right there, 67. So the implied volatility on the actual trade was 13%, and on the short put we've got 96 cents on the short put, which is at 11.3. There you see some evidence of the volatility smile that I mentioned in the previous lesson. Now we're going to go to our net sheet. I'm going to knock out everything except the two put trades. Bear with me while I get that up. And I'm having trouble keeping track of my cursor here. So there, we've got the put buy and the put sell with ones in it, which is right here. Okay. Everything else is tripped to zero. Now, I'm going to leave the stop at $5,000 because we're only, I've got to set 100 shares. Let's change that. I'll show you how to do that. That will be on tab option 1. And we'll change, oh, I'm okay. We got that. I'm sorry. We have that at 100, so that's fine. One each. That's all I want to look at. Okay, so far so good. We are at one put, one call. We have it set, if you recall, we have the tab option 1, which is our main input sheet. We've got that set at annual return of 10% up. Stock price is at 181. We've got the implied volatility at 13, which links directly to the 67 cents here. And we've gone with a 181 strike. Now we will use Crystal Ball to see what's the probability on this trade. So I've just clicked the Crystal Ball Monte Carlo simulator, and what we're going to see is what's the assessed probability of at least breaking even on this trade. And the trades will run as quickly as possible. We did 5,000 iterations, and I'm getting a 65% probability of breaking even on the trade. But I want to call your attention to something. Look at the mean right in here where I'm playing with the cursor. Mean expected payoff is effectively nothing, -$3. I'm not real happy with that trade. I've got to tell you, I'm not happy with that trade. But that's an example of a bull put credit spread. You have a 66% chance of breaking even, but the mean expected payoff is virtually nothing. This is a trade I would not make. The probabilities are not good enough. Now, demonstrating one more aspect so we can move right on to the bear call. We'll move on to a bear put trade. Let's hedge our bets. What I'm going to do is go in here and recalculate by putting in a trade that says, let's try a 178 put and a 179 put. Recalculate the trade. I think this was the one that paid us 11 cents. And sure enough, there it is. Let's go down and look at the prices, and we can see 28.39. So a bull put credit spread, we're going to drop this to 178, and I believe it was, I forgot already. It's 28.39. 28.39. So now let's raise the first price to 28, which is done right there. And on the short put, we'll trade at all the way down to 179, and we want that up to, I believe it was 30, well, we'll check, 37, I think it was. 28.39, not 37, 39. Okay, so let's change that to 39, and there we have it. The first sell is at 39, and our strikes are set now at 78.79. So now we're 20 points underneath the asset on open at Monday morning on open for a Friday expiry. So let's take a look at our net, and it should show us a maximum of an $11 win and a maximum loss. If we looked at maximum loss, we should get somewhere. We should get a loss position here. When you want it, it never happens, right? Oh, there was a loss, but I want to see what the maximum loss is. Not there. Well, you can see right away just by looking at this. This is a higher probability trade, quite intuitively. There's no numbers to this, but it looks like it's going to win much of the time. Nevertheless, the maximum loss will be the 11 minus the taken away from 100, so it'll be $89. Let's run crystal ball again. Bull put credit spread. We think SPY is going to stay even or go up. Let's look at our probabilities based upon crystal ball. Go to the net with stop sheet. And I'll shorten this up to 2,000 iterations so we can get faster results. And you can see our probability just went up dramatically to 86% of break even, or 87% chance of break even, and our mean expectation of winning on a trade at least is positive $2. Still not great, but certainly much better than a negative 3. You see, when we're playing spread trades, we are playing on, just like they say with football or baseball, this is a game of inches are too big. We're playing a game of millimeters here. This is razor thin. The probability trading that I've proposed in the vertical option spreads is razor thin trading. This is not directional trading. It's based on probability, trade size, and also consistency, consistency, consistency. I was somewhat annoyed by I'll show my own bias. I was annoyed by a couple of the reviews I saw on Amazon because clearly the readers had no clue what I was talking about and didn't read the book. That's my own opinion, and I'm sorry if they become colleagues, they will know that I was going into a much deeper than probability theory, and they had no clue. Granted to them, at the time, the website was not up and running as well, so all right, enough said about that. Would I make this trade? Personally, no. It's not enough of a probability for me. You might like it. You got an 87% chance of breaking even and a very small chance of really losing any money. All right, that's a bull put. Now, let's pretend that you think that the SPY is not going up, it's going down. Well, then you could try a bear put spread. So we're going to go into the options express trade. Now with a bear put spread, generally speaking, you want to be over the top. Let me tell you what I mean. If SPY's at 181, I'm going to want the long leg up maybe at 183, and I want the short leg at maybe 182. Just to give you an idea, I want to be on the other side of the asset itself with a bear put debit spread. So let's calculate that. And you'll see, now this is a debit spread, keep in mind. This is a debit spread. Your payoff diagram looks like this, reverse hockey stick, and your maximum gain is 33. But here, the observation with a bear put, the observation is that you believe the SPY is going to stay even or go down. So you're going to lose money if the SPY goes up. So it's the opposite side trade. Okay, and we'll get let me get the prices in here. And as you can see, so you're buying for 218, you're selling for 151, so you're going to be putting in about $68, $67 into this trade. You will pay to make this trade. It's not going to be a credit into your account. And if the trade wins in your favor, you will make $33. Let's see how this looks on our trade sheet. First of all, on the long put, I need to change this to 182. Okay, and on the beg your pardon, I'm going to knock that up to, yeah, I think it was 182. Let me check it once more. I keep forgetting what I did myself. 183 and 182. I beg my pardon. So we need to set this to 183. Tab option 183. And this sheet, short put, we want it at 182. So we'll go ahead and set this at 182 on the short put, tab option 2. Now I want to get the prices correct. The prices were 218 for the long put. 218 for the long put. So let's go get that set. That's on tab option 1, 282. And all we need to do is change the implied volatility till this reads 282. And there we have it. And on the short put, we want the price at 151. 151. So we'll lower the implied volatility till that reads 151. There it is. Now, you have just set up a bear put spread because the short put is at 182 on tab sheet option 2, and on tab sheet option 1, the long put set at 183, the prices are changed to suit. On the net sheet, we can leave the ones where they were at. And now on this trade, remember, this is the one where we should make, one of the reasons we want to do is if we think SPY is going down, we'll change this annual return to a down negative 10% annually. If we think it's going down, we might as well set it to down. So now let's look at how this trade's going to work out for us over time. The most we'll lose is the $66. That's, if I got this set up correctly, bear with me 1 second. Want to make sure. Long 183 at 282. I'm pretty sure that was right. No, I don't want to open that up. Excuse me. I want to make sure I got this set up correctly. Buy 183 at 218. Make sure you 218. How did I get 282? All right, let's try this again. Sorry about that. Got something stuck in my mind the incorrect way. I was wondering why the net sheet was so funny looking. Okay, there's 218. Now let's make sure we have the other ones set up correctly. The sell as 182 at 151. Short 182, 151. That looks more correct. And yeah, now everything makes a little more sense. I was wondering, what the devil am I looking at? So your maximum gain is 33. Your maximum loss would be 67. And you can see there's your maximum loss. So everything's working good. All we did was change the tab option 1, 2, strike prices and the asset prices. So let's lower this to 2,000 iterations to save a little time and run crystal ball and see our probability on the bear put, assuming that SPY is going to go down. And we'll look at the net with stop trade sheet. That's the most important. 82% likelihood of a break even, which is right here, and a mean return of $17. That's almost half of the max. That's more interesting to me. Now, part of it's a function probably of how the pricing is and also what the market thinks. Usually the market on the call side is a little more conservative than on the put side. You'll find that over time the option chains will generally show that the puts have more, the market is more afraid of the market going down than the market is afraid of the market going up. The market generally does not crash up. So that's why you'll sometimes find on the call side a little better opportunity to make a little bit of money. And on the put side, you'll generally find better probabilities. But that'll be covered. We have a long way to go, trust me. Right now, I'm just showing you how to use crystal ball and set up the trades. All right, ladies and gentlemen, I'm under some time pressure here. That was a bear put spread. Bear put. Now, let's look at a bull call and a bear call. And very easy to set up. We'll change this to a call, and we'll change this to a call, and we'll recalculate the trade. We'll leave the strikes the same for just demonstration time, and you will see on the bear call side that we have a credit spread. A bear call spread is a credit spread because we're buying at 22, selling at 50. Buying at 22, selling at 50, 183, 182. On the trading spreadsheet, we're going to toggle off the puts right here, toggle them off, toggle on the calls, and let's go set up the call strikes on tab option 3 and tab option 4. Now, the first trade we were looking at, or will look at, is the short call. And I believe that we went with a 183, 182. So what we want to do is set the short call at 182, and then I want this price to read what Options Express says. And on the 182 call, it's calling for an even 50 cents. So we don't have much to go there. There it is, 50 cents. 182 on a short call, tab option 3, 50 cents. And on the long call, we are looking at a 183 strike, so we'll set that correctly. And the price was 22 cents. So we'll set the implied volatility to be 22 cents. And you can see in the first line there, so 22, we have 183. Now notice I didn't do anything on the on the asset price on tab option 1. Let's go there real quick. On tab option 1, I left everything alone here. The reason being is that a bear call spread, the bear call spread, which is buying the high strike call and selling the low strike call, what we're actually thinking is that, again, the asset's going to go down. Okay? That's what we're believing. So on the bear call spread, now generally speaking, on the, it's interesting when I'm thinking about this, on the bear call spread, and you can find this in the books, where I generally like to be, I'll tell you right now, is on the other side of the trade. And I think you'll realize what I'm suggesting by reading through some of the books. SPY is trading at 181. I think that I'd rather be down at 179 and say 180. So we're going to set it that way. Let me go to tab option 3 and get this down to 178, something like that. I'd rather be on the other side of the trade compared to the puts. So on the bear put, I'll tell you what we'll do. On the bear put, what we'll do is we'll go right at the asset price, 181, and we'll put the short call at 180. Okay, that's where I want it. So I'm going to go to the options express sheet and change these, if you will, to on the long call, I want right at 181. And on the short call, we'll go at 180. And recalculate it. You might have to watch this tape a couple of times. You can always pause it. I know I'm going fast. Yeah, I kind of like this trade better. And I'm going to have to change the prices, $1.02 and $1.63. Let's see if I can remember that. So on the short call, it'll be $1.63 right there. And I couldn't remember, $1.02 on the long call. So long call, we want up at $1.02. So we'll set that at a 102, and there we have it. Okay, now we're ready to rock and roll. What'll this look like? Maximum profit is we'll check it with Options Express. Maximum profit $61. Maximum loss $39. So if SPY stays at 181 or goes down, you can kind of see your break evens. If SPY stays at 181, we're going to lose $39. But if it goes down to 180.61, we'll break even. And if it drops a buck, we'll make the full profit. And anything below that, we'll make the full profit. So that's the bear call spread. Now I want to test the probabilities on this. Everything is set up correctly. We'll run 2,000 iterations. And let's see what this has to say. And it's showing me, I'm not sure that that's not the old one. So let's reset the simulation and run it again. I want to make sure that we have a clean simulation. Now we'll hit the start key, let it run again. I have a feeling that was the old data in there. Now we'll be getting new data for sure. And because I'm so close, see, I'm only looking at a 46% chance of breaking even with a mean expected profit of $5, but a little less than a 50-50 chance. Nevertheless, that is a bear call spread. Bear call. You might have noticed that, okay, on a bear call spread, it was indeed as I told you, let's look at it. You were buying for $1.02, selling for, in this case, $1.63, the 181 and 180, if I had it set up correctly. So a bear call spread was a credit spread, obviously, a credit spread. So the bull put is a credit spread and the bear call is a credit spread. The bear put was a debit spread. Well, so will be the bull call. So we're going to close out by looking at a bull call spread. And to do that, all we're going to do is to change the purchase of this, what we'll do is we will flip this will be a buy and this will be a sell. And we'll recalculate it. So we're going to buy the 180 and sell the 181. And the prices should just flip on us, and exactly that's what happens. This is a bull call spread, believing that we think the SPY is going to go up during the week. It's going to be a debit spread. It's going to cost us $1.63 to buy the 180, and we're going to finance that with a 97-cent sale of a 180 win call. So let's do that on the trading spreadsheet. And we will first of all go to tab option 1 and change the probability to an up 10 because we think it's going up. Then we'll go to our on our short call. On our short call, we're going to change this to a 181. And on our long call, we're going to change this to a strike of 180. Now I want to get the prices right. The long call was at 163 on the 180. So let me get back to my trading spreadsheet. And do you believe that? I already forgot the price. $1.63. It should be close because we didn't change much, and it is. So we'll just change this to $1.63. Then we'll go to our short call. And for the short call, we're going to get 97 cents. So we need to drop the implied volatility down to where this equals 97 cents. This will be a bull call spread. It's a debit spread. You're going to have to pay money for this. I did change the annual return to a plus 10%, and now we can run the crystal ball simulation. Switches are set correctly. Sounds like we're flying an airplane, doesn't it? Let's run the, again, I think we got the old simulation, so I'm going to reset it and run it again. Bear with me. Okay, let's take a look at the probabilities on this. Should come up in a matter of just a moment or two. 2,000 iterations of the bull call spread. And I want to look at the net with stop sheet. 67% chance of gain, 67% chance of breaking even. This high spike at the end here shows us it's about 16% chance of losing the maximum amount. Mean gain of about $3 positive. So over the long term, you would expect that you'd get $3 out of this trade, with a maximum, of course, of the I think it was $33. Yeah, $34 was the maximum we could get on this trade. Okay, I'm running a little bit over time here, so let's review quickly. What did I try to accomplish here? I showed you, and you might have to watch this tape twice. I showed you 4 different spread combos: the bear put, the bull put, the bear call, and the bull call. The bull put is a credit spread. And usually you want to be on the lower side or the underneath the asset strike price. The bear put, you're going to want to generally be over the asset price, and the bear put is indeed a debit spread, and you think the asset's going down. On the bull put, you think the asset's going up. The bull and the bear gives it away for you. On the bull call option spread, what you want to do is, 1, generally be under the asset price or right at it on the short strike, and you are expecting the asset to go up a little bit, but you're hedging your bet. And on the bear call side, again, you think the asset's going to go down, and you generally want to be over the top of the asset price. So bull put, bull call, bear call. And then we went through all of the tabbed option sheets so that we could see how this spreadsheet handles it. We first must put in all our necessary data on tab option 1. The annual return expectations, if you want to leave it at 0, go ahead. It will affect your probabilities. We put in the asset price, the annual volatility estimates, and then we, of course, selected our strike prices. We went to the trading platform, looked up the asset price, and adjusted implied volatility at each strike. That allowed us to use Crystal Ball to use our analysis. All right, I'm over time on this. I apologize for that, but this is the first time, this is the first trading spreadsheet, part 6, where I have really gotten into some more specific detail on how exactly probability theory works. Now, next lesson I'm going to call the amazing spreadsheet, and I'm going to begin to show you some historical data and observations on how these trades work at different standard deviation points. So thanks for being with me today. Stay tuned. There's a lot more coming.